Welcome. Today's Thursday, June 8th. I'm Jeff Huge, Chief Investment Officer, JWH Investment Partners, and the founder of Alpha Insights. And this is your Daily Five. Daily Five is the show where we go through five charts that are kind of top of mind for us. I'd like to just spend 60 seconds, though, just kind of informing you about our monthly investment newsletter. We publish a monthly investment newsletter. It's available on Substack, and it's free to subscribe. It's delivered via email, usually on the first Saturday of each month, although next month it's actually the second Saturday because we wait for the jobs number to be reported. So next publication date's actually July 8th. The newsletter, affectionately titled Huge Insights, the Big Picture, is really a deep dive into the key macro factors driving the economy, driving the markets. And, we get a lot of positive feedback on this. We actually have a deeper dive version for those who want more. It's an upgrade to paid type version. It's as little as 39 cents a day. It gives you access to our monthly market forecast and our positioning recommendations. I think paid subscribers are pretty happy because we also provide them with some additional content, including our weekly Alpha Insights Idea Generator Lab publication, which details our top actionable trade idea every Wednesday, and also provides inter-week updated market commentary. At the same time, we also provide some additional perks, such as interim bulletin reports when something special is going on in the market, and also quarterly video content. So if you're interested in getting a little bit deeper, perspective on how we look at the markets, you can find more information on hugeinsights.substack.com. With that, let's jump into chart number one. Chart number one is a review and kind of an overview of our past market calls. Look, nobody's perfect, right? There's no analyst, no strategist, no portfolio manager, no trader, and certainly no spectator that is always right. We've made plenty of mistakes over the course of our careers, and we're not trying to suggest otherwise. And one example of that is we did not call the bottom in March of 2020. We struggled for a number of months before we eventually got back on the bull and rode it for 18 months all the way up to the January 4th top in 2022. We actually published a note and did a video presentation called Market Top Appears Close on December 5th, 2021, where we warned that we thought the market was very likely to top anytime, and then actually published a second report and did a video on January 6th, 2022, 2 days after the market top, discussing the Schmidt year and how we felt that it was poised to see a cycle decline deep into the fourth quarter. We proceeded to call most of the ebbs and flows of the market, all the way down to S&P 3500, which was a published target that we put out at one point. And actually in mid-October 2022, we called for a counter trend advance to carry the S&P 500 all the way back up to around 4,050 to 4,150. Now, the market has exceeded our target, and we are not without fault in this either. There was one big mea culpa after the SVB bank crisis. We thought that was it for the market. We had already retraced close to a 61.8% retracement. We didn't quite get there, but the break we thought was going to be it. And we put out a post and did a video here on StockCharts saying that the market was poised for a big decline. We were dead wrong on that call, and we apologize. The market has reversed higher. And last, I believe, May 25th, we came out and published a note, as well as did a big video presentation suggesting that the NASDAQ market was topping and that there was an imminent collapse. We suggested that the NASDAQ could retrace upwards of 61.8% with maybe another 3%. It's actually exceeded that expectation slightly through the midweek highs this week. But we believe that it is topping and rolling over right now. And we think the market is poised to make new bear market lows. So with that, let's take a look at a couple of pieces of evidence out there. Chart number two really digs a little bit deeper into a loose inverse correlation that exists between the 10-year Treasury yield and the S&P 500. And the question we're asking is, will the 10-year yield break out to a new cycle high? The peak so far is about 430, I think, on the 10-year yield. We have identified a level here, and we'll get into this, but it appears to us that there is kind of a small degree classic pattern base formation of the inverted head and shoulders variety that has resolved the upside. And if we look back over the past a year plus, since about December 2021, when rates have risen off an interim low, the S&P 500 has tended to move lower in the subsequent period until rates have peaked. Now, we have to suggest that this is not an exact relationship, right? It's a loose negative correlation between the 10-year and the Treasury. But given that, this has occurred on 5 separate observable occasions, and if we're correct about the breakout that we're seeing in this small degree inverted head and shoulders base, and it carries to a new cycle high with an estimated $1 trillion in new Treasury issuance expected in the weeks ahead, we have to ask the question, will this be number 6? And if it is, we will very likely see the S&P make much lower levels here in the coming days and weeks. Let's take a look at chart number 3. Chart number 3 kind of looks at this relationship in the context of what should we do with our capital if this is playing out. Well, we actually favor value versus growth. Over the last 4 or 5 trading days, we've seen portfolio managers trading down market cap, seeking out value in the other 493 stocks that aren't the Magnificent Seven. And we've seen a pretty aggressive oversold bounce in the mid, small, and micro cap space. But that being said, what we're looking at here is that if the 10-year Treasury yield is poised to move to a new cycle high like we think it is, then it's noteworthy to point out that the ratio of pure value to pure growth indexes have sustained a very high correlation to the direction of rates over the past 4 years. And so a sustained push to new highs in the 10-year yield would very likely be attended by a sustained period of outperformance by value stocks over growth stocks. So, it's our view, as we presented back on May 25th, that the NASDAQ 100 and the Magnificent Seven, including Apple, Microsoft, Google, NVIDIA, Amazon, Tesla, and Meta, are topping right here and right now, and will carry the broad indexes to new bear market lows. But institutional money can't leave the market. It will rotate. And we think that money could rotate into value stocks as a placeholder. If you look back to the dot-com bust as an example, value stocks actually performed admirably, even as the indexes careened to unexpected lows, down some 50% from their highs. In fact, bank stocks during that period were up 60%. So that might be an opportunity. We're not necessarily advocating it at this point, just simply pointing out that that was a place to hide. Let's take a look at chart number 4. And I wanted to kind of dig a little deeper into our long-term Elliott Wave Supercycle thesis. This is a chart that dates back to the early 20s, okay? It's over a century in duration here. And, our working hypothesis has been that the January 2022 peak ended cycle wave 5, and by extension, Supercycle wave 3, which was a 90-year advance that began back in 1932. Now, if this hypothesis is correct, then the US stock markets are in the very early innings of a 4th wave correction, ABC illustrated in the chart, at supercycle degree of trend. And under this rubric, cycle wave A down will likely trace out a 5-wave impulse sequence at primary degree of trend before it terminates. So far, we've been able to count 5 waves down at intermediate degree of trend to complete primary wave 1 down. Since that time, this current rally that we're experiencing is a counter trend advance, which is tracing out a corrective waveform known as a double zigzag. We've illustrated it, and you'll see in the next chart as WXY. And once it is complete, if it's not already, it will mark the end of primary wave 2 up. Primary wave 3 down will follow, and third waves are usually the most powerful in the impulse sequence. We think the entire process to complete the supercycle wave 4 could take at least a decade or more. So having said that, and just creating that context, let's take a look at chart number 5, which really zooms in on the counter trend advance that we've seen off that October 13th low. And this is our short-term Elliott Wave count, looking at this on a daily scale. Our preferred Elliott count now assumes that the October 13th low ended primary wave 1 down, and that primary wave 2 up, a counter trend advance, has been tracing out this double zigzag WXY corrective waveform. Last week's price action in the S&P carried the index to a new recovery high. Friday's upside gap in response to bullish news that the debt ceiling crisis had been averted looks like it was an exhaustion gap. And the peak that we saw on June 2nd so far appears to have ended that advance. In yesterday's attempt to challenge that maybe left a tweezer's top in place. We'll know in due course, right? But the point is there remains a small open chart gap at S&P 4305. The 618 retracement, which has kind of been our target here, that comes into play at 4312. And there's a prior fourth wave extreme, of course, the August 16th high, that comes into play at 4325. Now, if primary wave 2 still has any gas left in the tank, that cluster of resistance should contain the advance. Regardless, though, whether we've peaked or whether we have a slightly higher to go here, we think once primary wave 2 tops, prices should reverse hard down to new bear market lows in something of a spectacular fashion. Our target for primary wave 3 down is S&P 2750. Now, we'll know that we're in the midst of primary wave 3 down if the S&P breaks below 4186. That's kind of our level to confirm that primary wave 3 down has begun. So keep your eye on that level. And with that, I would just like to say, if you want to follow up with us, you can go to our website at jwhinvestment.com. You can follow us on Twitter at alpha_insights, or sign up for our newsletter, hugeinsights.substack.com. And with that, I want to thank you very much for watching and wish you the best of luck trading.